Do you want to retire early and rich? These three iShares ETFs are the way to make it happen. Along with Vanguard and State Street, BlackRock is one of the biggest ETF issuers in the world, and of course, one of the biggest money managers, period. Hands down, they are one of the absolute number one money managers in the world. If you're looking for retirement investing and experience starting out, iShares ETFs have a very strong lineup, very similar to what we see with the Vanguard. A majority of these funds do track indexes, and they have hundreds of ETFs to choose from, which is kind of crazy. And also, they are the perfect building block for 401ks, IRAs, and pretty much anything out. Now, when you look at the iShares lineup, again, it is very similar to what we see with the Vanguard, with really the focus on a very low cost and also a plain vanilla kind of index portfolio. But iShares might actually have somewhat of an advantage because of the sector-specific factors and also the niche orientated of some of those ETFs. And of course, they do hold the Bitcoin. So the iShares Bitcoin ETF, or the IBIT, is over $18 billion. When it comes to Bitcoin investing, it is the largest issuer within the United States, which is kind of crazy to think about. When you look at the Bitcoin ETF, and of course, should retirement portfolios actually have Bitcoin in them? That is yet to be seen exactly how the performance really comes over the long term. But again, that is going to be interesting to see. Now, of course, in today's video, we're going to be looking at the three perfect iShares ETFs for retirement, starting off with number one, which is the iShares Core S&P Total US Stock Market ETF, or the ITOT. Now, very similar to what we see from the VTI, this is essentially the iShares tracking of the total United States market, which means you're going to have exposure to those large caps, exposure to the mid caps, and also those smaller caps, which is a very good lineup. Now, of course, the 0.03 expense ratio is just as same as the VTI. And of course, it does track kind of the same index of everything. Now, the big difference between this, of course, looking at the ITOT is looking again at the heavy or the large cap is 75% of this portfolio. The mid cap is allocated 18%. Small caps are 7%. And of course, you're looking at the entire US market, meaning there's roughly about 3,700 stocks in here, which makes it perfect. Again, if you're not looking at the Vanguard total stock market or the VTI, this is the choice that we have from BlackRock and that we have from iShares. Now, of course, the other one from this we look at is the iShares Core Total USD Bond Market ETF, or the IUSB. This, of course, is the bonds. Now, when it comes to all of these portfolios, they do have a majority of bonds in there, or a big part of bonds. Personally, like I've shared before with some of the other ones that we've looked at for ETFs, I do not invest in the bond market. I feel like the performance, especially when you start looking at kind of a bigger scale, the bonds really do underperform the market. I would rather, and again, kind of depending on your age, I would rather put something in there that is really focused on a lot more growth than putting the bonds in here myself to really round it out and making sure that you have a very good growth sector. And essentially, if you're getting ready to retirement, bonds might be an option, but I overall believe and really feel that going for a little bit more growth, a little bit less bonds, is going to essentially give you a lot more longevity within the portfolio when you're through those retirement years. But looking at the bond, the IUSBC, this is one that is really encompassing all of the bonds. We've seen this again, very similar when it comes to Vanguard. But the thing is, similar to what we see with the other ones, is it is 70% of the portfolio assets within here are, again, US Treasuries, mortgage-backed securities. So we've seen it with Fidelity, we've seen it with Vanguard, we've seen their own essentially different kind of funds or different fund that tracks the exact same thing, which really eliminates diversification in its entirety when it comes to the bond market, because 70% of it is just in there. Now, again, we've talked about, if the US ever does default, if it ever downgrades any of the bonds, if anything should happen, 70% of the assets within this ETF itself are tied to the US, essentially to the government in the US Treasuries themselves. Now, of course, when you start looking at the deficiency, there's also the IUSB. Some of the deficiencies, government security is a little bit lower, which kind of is a step in the right direction. But the variation of this does allocate more towards junk bonds, which again, a lot of people do not like doing the junk bonds. And even if you look at the yield of this, it's yielding about 4.8%, which is still pretty good. So, I mean, you're yielding about 5%. But again, when I think of ETFs and when I think of kind of the ability to grow, this is not very much of a growth factor. We're looking at probably 1 to 2% over an extended amount of time. When you're looking at 5-10 years, you're looking at 1 to 2% with, again, a 4.8% return. However, M1 Finance down below, I have a 5% cash account, which means you're going to be earning more than you are actually yielding right here with the bonds. In addition, there's a lot of different places you can get CDs, but if you start looking in some of the larger funds, some of the growth funds, even looking, in the larger all market funds, you are seeing a tremendous amount of growth, still a pretty good dividend yield out of there, but there are a lot of dividend ETFs, of course, that are working well, which is the third one we're looking at. But before we get into it, go ahead and subscribe to the channel. Let me know in the comments what you guys think about iShares from BlackRock. And the final one in here is the iShares Core Dividend Growth ETF, the DGRO. Now, this is actually one that I have had a couple subscribers tell me about. Check out the iShare one. And of course, this is really the dividend side of it. So we have kind of the total market that we're investing in. We have the bonds, which is our secondary one. And then the final one is always kind of this dividend piece. Now, the dividend piece is, again, the third part to our 3-part ETF portfolios. And this is really ideal to retirement. Now, again, when you think about it, these are a lot more defensive, cash rich in nature, and do yield a pretty good return, which is the reason why people do hold these. And of course, this is really good when it comes to not only growing dividends and giving you kind of dividends back, but also having quality companies that it's invested in, and also seeing some growth out of there, which again is really big. Not only do I want something that is going to pay me a return, but I don't want the return to be the only thing that it is paying me, which is the reason why I do like this. Now, when you start looking at this as the dividend growth screen ensures that companies have, again, been paying dividends and growth more than 5 years, which is good. They earn a payout ratio, which ensures the degree of diversity or the dividend, actually the matrix that they go by, and eliminates the highest yield. Now, of course, when you start thinking of higher yields, and this is kind of a double-edged sword, is when you start getting into the higher yields, this is eliminating the higher yields, because with the higher yields, I mean, when you start getting in the 7, 8, 9, 10% yields, the risk is very, very high. If you want to keep the risk down, this is not only going to cut a little bit of the yield, but it's also going to essentially mitigate a lot of the risk. I would rather be safe than sorry when it comes to portfolios. And of course, this is going to be a long-term play. When you start looking at these, it is really a long-term play that you're really building on here with these portfolios. Now, of course, when you start looking in this, the iShare currently has more than 400 individual ETFs, which is insane. I know a majority of the companies do not possess that many, but these are definitely 3 that are well poised for growth and really build out the portfolio. So when we look at the first one, iShares Core S&P Total US Stock Market, again, the ITOT. The second one was the iShares Core Total USD Bond Market, which was the IUSB. And the final one was the iShares Core Dividend Growth ETF, or the DGRO. Now, me personally, I don't invest in any of these ETFs. I do have the SCHD, which again is kind of the dividend. I have the VYM, which is the dividend from Vanguard. Most of the funds that I carry are Schwab, and I do have some Invesco, and I do have some Vanguard as well to really round out my portfolio. All right, guys, that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.